Welcome to the Three Edge Week in Review for the week of April 12th. I'm Fritz Foltz, the Chief Investment Strategist here at Three Edge, and I'm joined here once again today by Steve Cucchiaro, President and Chief Investment Officer at Three Edge Asset Management. Today, along with a brief update of the global capital markets, Steve and I will be discussing why international equities could be the next attractive market opportunity. But first, let's take a brief look at the global capital markets this week. And global equities continued their march higher to new all-time highs during the week. The S&P 500 index recorded its sixth weekly advance in the past 7 weeks as strong U.S. economic data, including retail sales and jobless claims, fueled continued investor optimism. Investor sentiment was also bolstered by a report out of China that the world's second largest economy grew by over 18% in the first quarter. Now, granted, that was from a very low base because of the pandemic, but retail sales in China actually increased by over 34% in Q1 2021. In addition, European equity markets also advanced for a seventh week, and that was its longest win streak for European equities since May 2018. So now let's move on and let's discuss our topic for today, which focuses on the potential opportunity in international equities. So Steve, right now, based on our model research, we have allocated to equity asset classes outside the US. And so perhaps it would be good to just let us know what are the major reasons that our research model finds international equities to be attractive.
Well, Fritz, based on our model research, some of the same primary factors that have been driving and fueling the record levels in the US stock market are present in increasing the attractiveness of international equities. One in particular, just like in the US, we have massive money printing and creation of reserves and monetary stimulus from the Federal Reserve Board. Well, the same is true with the major central banks around the world. In fact, one example, Japan, not only are they printing lots and lots of reserves and using that to buy market securities, but not only are they buying bonds like in the US, they're actually buying equities with some of their printed money. And so they're buying Japanese equities alongside ourselves and others who invest in Japan. So that is quite extraordinary. Now, there is a major difference, though, what our model is saying between the US and the international equities. And that has to do with valuation. Our model shows that international equities are relatively much more fairly valued or undervalued compared with the US. And the US right now is as overvalued as it's ever been based on our measures. So even though right now the US economy is rebounding more quickly than overseas, a lot of that is due to the more rapid rollout of the vaccinations. And we have no doubt that vaccination rollouts will continue, not just in the US, but around the world, and the world has a chance to catch up. So we see, in fact, more potential upside of international stocks catching up as they become more vaccinated.
Excellent. And so it certainly seems that because US equities have outperformed for so long, many investors are focused almost exclusively on the US equity market. So perhaps it could be helpful if you point out a few of the periods of time where international equities actually outperformed the US equity market, so looking back at market history.
So you're right. Lately, US equities have outperformed generally since the financial crisis of 2008. And sometimes when a trend is in place, it seems like it's going to be indefinite. And there are people who are asking, well, don't US equities always outperform international equities? Isn't that just the natural order of things? And so we'd like to share a chart we put together that clearly shows over the last several decades that it is not true that US equities always outperform international equities. In fact, quite the contrary, they change places back and forth. They alternate over multi-year periods. And so you can see several periods where international equities greatly outperformed, several periods where US equities have outperformed. It happens that right now we are in one of the longer duration multi-year periods where US equities have outperformed. And there's no automatic rule that says after a certain amount of time it needs to switch. It really needs a catalyst. But we do believe, and based on our model research, that the catalyst is now present to switch from outperformance of the US over to international equities. For instance, we believe that because the companies in the international equity indices that we invest in are largely more concentrated in sectors whose fortunes are tied more to the performance of the real economy. And because we are now coming out of COVID around the world, because we have this massive stimulus, including now fiscal stimulus, we do think the real economy now has a chance to grow more quickly than it had in the past. And so this should, all else being equal, favor those companies whose fortunes are tied to the real economy. And where the US index has a preponderance of companies, technology companies and others whose fortunes are not so tied to the real economy, we think this can be the catalyst to swing in favor of the companies that are outside the US right now.
Very good. And so then actually that raises one more question. And I know that you are very much a market historian. And so now I'm thinking really specifically, if you could point out periods in market history when in the recent past, say for 1, 2, 3 year period, a particular equity market outperformed, and this was followed by a shift to another country, and that other country then was to take up the market leadership for a period of time. Do you have any examples of that occurrence?
Well, there was certainly one time in history that comes to mind that very much describes that, but the players changed then. And so in the late 1980s, Japan and the Japanese equity market was soaring.
Mm-hmm.
And I don't know if you recall, but there were many books written about how other countries should adopt the Japanese productivity methods. There was a thought that the Japanese economy was going to take over the world. Valuations were very stretched. People thought they were as extreme as they could get, but the Japanese market kept going and making more and more new records. And this happened right through the late 1980s. And then in January of 1990, the Japanese stock market bubble burst. And over the next several months, the Japanese market fell over 80%. And for the entire decade, there was poor performance from the Japanese equity market. However, other markets like the US market, for example, have one of their best decades ever.
Right.
So we know that these trends can persist for a long time, and we know that US equities have outperformed for a long time, but their valuations stretched far beyond the underlying fundamentals. And so we do think that now it's much more reasonable to expect there's an opportunity for international equities to at least catch up. And if the upside continues in the global markets, we think international equities have further upside. Should be an upset in the global markets, we think because the US market is more overvalued, there's more downside potential with the US. One other point I should also mention is that when we invest in international equities, it's not like we're just making a bet on other countries, because a lot of the companies in the indices that we invest in export their products all over the world.
Right.
They're world-class companies. They're not just tied to the local economy that they might be in. And yet, because of investor preferences, investors have really stretched the valuations of US equities in a way they haven't elsewhere. So we do think there's an excellent opportunity here for investing in international equities with good outcomes.
That last point that you made is very important, and I think something that is oftentimes overlooked. So thanks for that. So that will do it for Steve and me. We'll be back next week with another edition of the 3Edge Week in Review. Remember that all our videos are available on our 3Edge YouTube channel, as well as on our website at 3edgeam.com. And you can subscribe to our 3Edge YouTube channel as well, in which case you'll be notified as we release videos in the future. In addition, if you'd like to submit any questions, make suggestions for future topics, very much like to hear from you, and you can send us an email at weekinreview, all one word, weekinreview at 3edgeam.com. So now, on behalf of everyone here at 3Edge, we urge you to remain vigilant, stay safe, stay strong, and keep the faith. And most importantly, thanks for listening.